Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the fundamental news that moves the markets, because it's all fundamentals. And Tori's got a couple for us today.
We finally won him over, Rob.
You didn't.
No, I'm just kidding.
I'm permanently pessimist, and the charts are the only thing that matter.
Yeah,
so we're going to
Mr.
start
Chart
there today.
Yeah. We normally do start with charts, so let's reverse the order. I tend to be Mr. Fundamental, you're Mr. Charts, and Rob is Mr. Color Neutral. We'll have fun today, and I think it's a really important thing to do on a regular basis, to remind yourself as an investor why you're buying gold, right? You hear all these news ads and you're reading different things in papers and stuff, but to compile it into one thought process to me is really important. And I think the one that is probably top of mind in terms of economic fundamentals is just the U.S. national debt. It continues to run higher as a result of government spending. And now our debt to GDP is 122%. Like, that is game changer from when Volcker was fighting inflation in the 80s and trying to manipulate interest rates for that. And there's no indication of a reversal right now. And that's all despite record tax revenues. It's not like our tax revenues have fallen off. Tax revenues are high, and here we are at 122%.
Well, and let's put it in perspective, because the trillions and the billions, they just kind of go over people's heads.
That's a lot of zeros.
It's a lot of zeros. And let's take 8 zeros off of the numbers and pretend the U.S. government is a single-family household. But I want to also adjust those numbers to more of a realistic view. So instead of annual family income of $21,700, let's triple that. Let's say the average annual income for the typical family is $65,100, and that's closer to reality for most people. Then that means that their annual family expenditures is $114,600 versus a $65,000 annual income. So new debt on their credit card is now $49,500. Outstanding debt on the credit card is $428,000 and change, but total budget cuts so far was $115. That's what it looks like.
I mean, think about that. What's another $49,000 on your credit card this year when you already have $450,000 in credit card debt? And that's Washington that's numb to the numbers.
Yeah.
It seems like it's like, what's another $10 billion here and there?
Right.
That's mind-blowing.
That's the equivalent of going to Starbucks one less time per week compared to
saving the $115.
Yeah, saving $115.
But we saved $115. We're budget hawks.
Yeah, good job, guys. Yeah, that's well, that does put it into perspective. And I'll tell you the other thing, I don't think they're going to be cutting interest rates in March. We've talked about it. Maybe they boldly do that, but the economic numbers that they use to base it off of in terms of the jobs and the inflation numbers don't support it. So they're going to have to go against their own justifications for raising rates in order to cut rates. They'll have to do a complete 180.
And the Fed today really did not lead anybody to think that they would be cutting rates.
That's right. And the stock market, unfortunately, like we talked about, has priced in those rate cuts. So
they have.
Fundamental number 2 is there's stock market weakness. It appears to be a topping.
Well,
right?
especially with NVIDIA.
Well, that's right. And now they've got earnings coming out, and you talk about something that its market cap has increased 3 times in 1 year, 3x. That's never happened before. So that's a bubble. Now, can it keep climbing? Sure. I'm not calling the bubble's bursting this week. I'm just saying that's a bubble.
You know, it's funny. I've been thinking about when they made that initial announcement here a couple months ago that they may be looking at least holding rates here, if not cutting them. My first argument was, well, if they start cutting rates next year, that's a pretty clear political agenda move.
Right.
And realistically, the Federal Reserve Bank is supposed to be apolitical on paper, right? We can argue whatever we want to argue, but on paper. But what they're not supposed to be is pro-market trends. And how ironic is it that they happen to make those announcements right around the holiday season, and now we've moved out of the holiday season, they're backtracking everything. So maybe it wasn't a political move. It was just a end of year, I don't know, accounting paperwork move.
A little Christmas gift.
A little Christmas
gift
bonus.
to the Wall Streeters.
Yeah. So they can get their bonuses.
That's right.
Yeah.
That's right.
So
another indication to me of stock market kind of topping in a sense is just what Rob said, a handful of tech companies are supporting it. It's not an indication of a thriving U.S. economy. The numbers aren't supporting that. And then the U.S. dollar is due for a downturn. It's got a serious target. The global de-dollarization is a great concern right now to us, right? And so Egypt coming out and talking about selling oil, circumventing the petrodollar.
Well, and the de-dollarization is occurring on two different fronts that we don't address very much. One is the gold market out of Shanghai. A lot of that de-dollarization, you're seeing record buying out of the Shanghai exchange. Now, some of that was led up to by Indian wedding season in the fall, but now we're in Chinese New Year, another boom. Seasonally, these are seasonal factors.
Ramadan
and Ramadan's coming up. So the annual sale of physical gold, not paper gold, physical gold from the Shanghai exchange, if it continues, and it probably won't, but let's just say it does, that's equal to all the gold production for this year of new mine supply. So that's one factor of de-dollarization. It's going into gold. The second is the drive from all these other nations into the new CBDCs. They are aggressively pursuing central bank digital currencies and trying to get that implemented, whereas the United States is not. We have maybe 20 people working on this new CBDC, this Fed dollar, so to speak, whereas the Chinese have 300 people working on it around the clock. So we are falling behind. We're not, according to what I'm reading, the Fed isn't really pursuing a CBDC, but maybe they'll have to, because the rest of the world is passing us by into physical gold and into digital currency, which I'm not arguing for the Fed currency going digital, going crypto, but the rest of the world is moving in that direction, and they're certainly moving into gold.
Yeah, I totally agree. And the de-dollarization drives weakness in the Treasury market. So there's another underlying fundamental with gold, right? So the Treasury yields and what they're doing, they become less attractive as a safe haven investment. Gold becomes more attractive in that instance. So
exactly.
And there's a de-dollarization domestically, you know, by banks and hedge funds where they're looking for different alternatives. And the gold's going to be at the top of that. You know, market uncertainty is going to accelerate this year in general, all economic markets globally. And the U.S. banking crisis is really due for a second wave.
I totally agree.
There are a lot of red flags. And you guys talked about the banks here a couple weeks ago, but the lending facility that they created a year ago has topped $130 billion. And that tells us that regulators are stepping up to prop up the banking sector. And nobody's talking about it. No. And on top of that, you've had a doubling in the Federal Home Loan Bank, which is the other interior structure of the banks. I mean, that's topped $1.1 trillion in terms of selling bonds to fund the banking system. So that's a sketchy deal to me. So if you get continued bank instability, again, good for gold. Not every fundamental is bullish all the time, right? There's bearish where the gold price could come down, bullish where it would go up. And these can go any direction, but right now these tend to be stacking up in bullish fashion. We've got political uncertainty. Domestically, we have geopolitical uncertainty. Certainly those tensions and the concerns for war are intensifying and spreading, expanding. And then we have gold and silver, which is, let's segue into Miles here. Miles, you finally get to say something about the charts because gold and silver are forming a really intriguing technical base. We were talking off mic and just how encouraging it is to see these support levels. And you know, have we started another springboard rally kind of thing?
That's been the seasonally for gold and silver has been the spring, not so much the fall like it used to be. It's now the spring that seems to be the strong seasonal market for gold for the same reasons we just discussed.
Yeah. And I don't see good news causing the gold prices to drop precipitously. We're one news event away, news events we can't even think about right now that are going to happen this year that will drive gold higher. So despite all those underlying fundamentals, there are some unknowns that we could get creative and wild about.
Well, Israel is taking the war into Lebanon. They struck deep into Lebanon by bombing Sidon, you know, just the other day.
Yeah, that's what I'm saying.
Not on the border. Expansion. That's way into Lebanon. So, yeah, it's spreading.
Yep. Yeah, so the unknown news is also going to add to gold. But Miles, let's transition over. Kick us off just with the gold chart and what we've seen here this week.
Sure. I don't know if I can top that, guys. But gold is trying, coming off a pretty deep decline that we talked about here over the last week or two. We had a single day drop of around $40, bottomed out. This would have been Tuesday, Wednesday last week. And we've been nothing but up since then. I think we've had, 5, 6 trading days up in a row, and we've kind of reclaimed all of that territory that we lost. So gold sitting here in the 2020s, which was one of our support levels. We're back above it. I would argue if gold's going to continue up, don't mishear me. I'm not the optimist yet, but if gold is going to continue up, we're probably going to need to see us back above highs from back in February and January. So that puts us in the 2060s. But I think getting back to what you guys brought up here a second ago, I think there's something that I want to mention one more time. I've said it a couple times now over the last couple of weeks, because we have been talking about the techs, Microsoft, NVIDIA, and what they're doing collectively to build up the rest of the market. So you look at something like the S&P 500, pretty broad range indicator there, up 5% off the previous all-time highs. So not a bad move. But you compare that to the rest of the market in general, like the Russell 2000, looking at small and mid-cap stocks, you're still down 20% from the previous highs. It's still in major bearish territory and not showing much strength. So you compare that to something like gold, which is currently sitting and possibly on the rise here, but currently sitting only down about 5% off the high. We've had a pretty shallow and frankly not significant enough correction at this point. And that was one of my big things I brought up here a couple weeks ago as we were watching gold come down, is we haven't done much to the downside. If you look at the entire rise since last October, you're talking 1,800 to 2,150. A pretty significant increase over the course of just a couple months, almost 20%. Of course, you're going to have a little bit of a pullback to follow that, but we haven't really seen it. We saw a big decline back in middle of December. It got down to 1980. Well, lo and behold, we just got down and possibly double bottomed here at 1980, and maybe it bounces around this level here for a little bit. But like you said, as we move into what has become the tumultuous time for the markets, March, April, May, there's no reason we're not looking at gold at higher prices, breakout levels. So when you stretch this chart out over the last couple of years, we've just built this shelf between like 1,800 and 2,000, 2,100. Most of your trading in the gold price prior to, say, February of last year was between, say, 1,680 and 1,900, with some outliers above and below. Well, now it seems like most of your trading in the gold price is going to be between the previous top end, 1,900, and the new top end, maybe 2,050. So we're building the stair steps that I talk about a lot. When you want nice, long-term, healthy growth in a market, you want to see sustained, measurable increases stretched out over a long period of time. You don't want to see what happened in Bitcoin. You don't want to see what happened in rhodium or palladium. You want to see building of these stair steps over time where you're setting new base levels that the market can grow on top of. So I would love to see gold very slowly for the rest of my life just increase up at a reasonable percentage every year. But unfortunately, that's going to come alongside what, Rob, you were talking about a minute ago when we look at the government spending and inflation. So I don't really know what the solution to the problem here is other than buy gold and maybe do a little bit of investing on some other things that we want to talk about today too.
No, that's a really, really good summary. And to me, I'm hoping that 50% retracement is enough. If we are stair-stepping up, Miles, as the perma bear sometimes, wouldn't be satisfied with just a 50% retracement from that high. He's looking for the 618 fib, probably. Anyway,
well, it's not that far down there.
No, it's just
the
not.
618 is what, 1970?
1940.
Oh,
Yeah.
okay.
If you're just looking at the
200-day.
short-term move.
The short term, that longer term
Yeah.
from where you were describing this rally up from 1800 to
Okay.
2150. I mean, from 1680 to 2150, right? Do we give up more than that? So I hope not, but at the same time, it comes at a cost. And the cost is irresponsible spending and money creation. And Rob, you being the money supply hawk, that speaks to it more than anything. And are we going to continue to juice the markets and money supply, or does de-dollarization win out, which ends up shrinking the global money supply? Who knows?
We have backed ourselves into a corner. The one thing that Chairman Powell did talk about today is addressing the balance sheet. So I'm not sure what he meant by that. We'll find out.
Yeah, well, if he were really serious about the federal government spending, he does have something to say about it. At some point, you can hold him accountable. So what about silver miles? I mean, that's been the one that's shrunk our ratio. It's turned it the wrong direction here. We were having a nice little run, and now we're off 5 points from that 92 high. What do you see going on there?
Yeah, well, when you look at the silver over the last couple of years, you're really stuck in a pretty tight range. You know, you're looking at low 22s to mid 24s, where most of your trading has taken place. And then you've got an outside range between about 20 and a half and a little over 26. And that's where the bulk of the rest of your trading, like silver trading, is almost this perfect bell curve, where on the outliers, you have like 18 or 19 bucks on one side, and you've got 28, 29 on the other. But as you get closer to the center of that bell curve, you've got the majority of your silver trading right in this tight range. So while we've seen gold over the last 3 years set these new higher highs, silver really hasn't done anything. And I'm hesitant on silver, certainly not hesitant to recommend it, because I love silver and I love buying silver, and I think it's way undervalued compared to the other metals. But there's something I think everybody needs to be aware of, and it's you've got to have the stomach for it. Because if we go back and we look at the previous bull market, the bull market in gold wasn't 2008 to 2011. The bull market in gold was like 2002 until 2011. It was like 10 years. See, everybody talks about when gold went from 1,000 to 2,000. Somehow we've forgotten that gold went from 250 to 1,000 in, what was that, 7 years?
Yeah.
6 years?
Right.
Something like that?
Yeah, and then in 2.5 years,
It doubled from there.
Yeah.
So the first quadrupling of gold, most of the market missed. And in that same period of time, we saw silver go from $3 or $4 up to like $7. So it took a while for silver really to play catch up. Now, as we all know, when push came to shove at the tail end of the bull market, silver goes from 15 to 50. It just explodes. But it all happened at once, and it all happened on the back end.
and it was all short-lived.
Yeah. And so one of my big concerns with silver, it's probably the better investment. If you want to be realistic, if you're just looking at the brass tacks and the numbers of it, silver wins, no question. But do you have the stomach for it? Because if this bull market in gold continues like in that stair-step pattern like I was just talking about, silver isn't going to play catch-up till the market gets panicked. And if it's going to slowly stair-step up over the next 5 years, gold could be 2,500, 3,000, 3,500, and silver's maybe $30. You know, maybe it's come up another 5. And then all of a sudden at some point, gold goes to 5,000 and silver goes from 30 to 150. But it's all short-lived. It all happens at once. And I just want to make sure people are aware that you've got to have the stomach for it. So maybe there's some things you can do in the meantime to where you're not just sitting on your silver waiting for silver to play catch up in terms of those inflated US dollars. And that's where the ratio comes in. You want to be selective with your ratio trades and work with somebody who's watching this on a daily basis. But I think that's where the real play in silver is. So I'm highly encouraging listeners, if you're looking at the price of silver lagging behind gold in terms of US dollar production, I'd really continue to encourage you in thinking of silver, not in terms of how many dollars can it make me, but how many ounces of extra gold can I acquire on the back end? Because that's where the growth actually comes in.
Yeah, that's right. Wouldn't that be nice to know exactly when silver's rally is legitimate and going, and in the meantime, you sit in gold? So last year, as an example, you get 13% return on your gold when silver was flat. So probably arguably a little early to be buying silver. But if you're not early, the problem is you could miss it. You could just be late. And that's silver's price activity. So you've got to diversify into some of it. But in the meantime, a solid gold exposure is always a safe bet for your portfolio.
Agreed.
And while you're prepping to give one of us a call about your silver and gold positions, ask us about platinum and palladium. We didn't have time to cover it today, but it's definitely something that you should be talking to your advisor at McIlvaney Precious Metals about as well. So maybe we'll have the platinum conversation next week because it's starting to look interesting too. So that's going to do it this week for Golden Rule Radio. As always, we appreciate you joining us. If you'd like to discuss your personal portfolio, give one of us a buzz. We can be reached at 800-525-9556. You can find more info on our website at McIlvaney.com. We're on Twitter at ICA Gold and Facebook at McIlvaney Financial. Thanks again for listening. Have a great week.